Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone that you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you, giving you the sincere and actionable ideas that you need to improve the lives of yourself and your loved ones financially. That's what it's all about. And listen, right away in the A block, we've got our guests. And I want to talk about something that was so disruptive, it's going to be landing in people's mailbox inside of a week or two, which are these phantom tax bills. Now, no one wants large amounts of phantom income, but let me tell you, phantom income's coming. David, good morning. A very happy Sunday to you. David, you were on this show and you were giving everybody warning signs at the end of November into December to give them the opportunity to sidestep a conundrum. And I am hoping that people didn't make any reallocation decisions, or I'm hoping some people chose to sidestep. David, what are these capital gain distributions? Where do they come from? Why do they come? And what's the learning lesson that everybody should have after paying the bill for 2026?
Well, we start with the distinction between capital gains and capital gain distributions. Lots of people like capital gains. It means you sold an asset for a profit. Capital gain distributions are often what we call in the business phantom income tax. Where do they come from? Generally mutual funds, stock mutual funds. And the issue is when those stock mutual funds are held in a non-qualified investment account, a non-IRA, non-401k. When do the distributions get paid? They typically get paid around December, albeit they could come throughout the middle of the year. But this was a huge year for capital gain distributions because we had lots of volatility in 2025. So the more volatility you have, oftentimes the greater chance that you have these capital gain distributions. And here's the tough part about it. You may have bought a mutual fund in November only to get hit with a capital gain distribution in December, and now you have a phantom income tax bill, even though you may have not been very profitable on that investment. And when we talk investing, Craig, the term we use is what's our after-tax return? We don't want to give away any of these returns to the IRS. So we need to think about changing the investment vehicle oftentimes that we're using in these non-qualified accounts.
So David, talk exactly about that, the investment vehicle. Talk about the platform, because that's what gets people confused between mutual funds, exchange traded funds, separately managed accounts. What are we doing as a set of best practices? Because I think 2 out of those 3 are good solutions.
Yeah, I mean, I think the way you say it all the time is thou shall never own a stock mutual fund in a taxable account. But I think the key is we want to control what we can as we move into retirement. And one of the things that we can control are the investment vehicles we use. And you have choices today, which is great, right? You can buy mutual funds, ETFs, individual stocks and bonds. But I think if we have our way, we don't want to own mutual funds and taxable accounts. Our preference is to own ETFs, or better yet, in certain cases, depending on account size and net worth, we want to be owning individual stocks and individual bonds because that gives us more opportunities to be tax efficient.
No, David, you're absolutely right. So listen, we're going to talk specifically about DI. DI, David, standing for again?
Direct indexing.
We're going to talk about that now, but you're going to want to learn more. I'm going to show you how to do it. You're going to give us a call at 833-964-PLAN. That's 833-964-PLAN, or go out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. So what is direct indexing? We've talked about it before. We got to talk about it again. In the 1970s, we created index mutual funds. Some 20 years later, there was a technological leap where mutual funds were born and morphed into exchange traded funds. Leap forward another couple of decades, and that's where direct indexing came in. And direct indexing is a strategy that simply looks to replicate an existing stock index, like the S&P 500, like the Russell 1000, like the Russell 3000. But when you direct index, you actually have physical ownership of the individual stocks that make up the index. So David, I ask you, David, if you own the S&P 500 mutual fund, the S&P 500 exchange traded fund, or you own the 500 stocks in the exact proportion you're supposed to, meaning you own the 500 individual stocks that make up the S&P 500, in all three of those, are you going to have the same performance?
Yes.
But when you own the mutual fund and you own the exchange traded fund, do you get the ability throughout the year to go in and sell the stocks that are down in price?
You don't, because you don't own the shares.
That's right. So when you direct index, you own the individual stocks that make up the index, which give you the opportunity then to track the performance of the index, all the upside and the downside, but you get the ability to tax loss harvest throughout the year. So if you can get the power of stocks, the power of the index, but have the opportunity to put tax deductions on your 1040, isn't that a fantastic strategy for most, David?
Yeah, and let's make the distinction, right? Because taxed harvesting is not a unique concept. Lots of advisors and lots of firms taxed harvest, but when they're taxed harvesting, oftentimes what they're doing is at the end of the year, they're maybe selling a mutual fund or they're selling an ETF that may have had a loss. Well, again, if most stocks went up in an ETF, the price of the ETF went up. The direct indexing ability gives us the opportunity set to take advantage of the losers, because there's always going to be some losing stocks if you're investing in 500 or 1,000 stocks. And it's not just at the end of the year, it's continuously throughout the year. And I got to be honest, the one thing I'm excited about going into 2026, Craig, is the way we've built out direct indexing at VestGen is we have level 101 direct indexing, level 201, and now we have level 301 direct indexing to help all of those investors that have accounts where there aren't a tremendous amount of losses anymore due to some market appreciation.
No, David, you're exactly right. So 833-964-PLAN, 833-964-PLAN. Go out to our website, GetRetiredStayRetired.com, GetRetiredStayRetired.com. What we were talking about this morning is, again, avoiding those phantom income tax bills, making sure you make 2026 the year that you no longer get capital gain distributions, meaning phantom income tax, something that you're paying taxes on that other people sold while you did the right thing and held. That's going to be carving out those mutual funds from your portfolio so they no longer exist in your non-retirement account, and using that concept of leveling up and possibly direct indexing is an example to level up. And David, first, our mission is to get everybody where they need to be. And then our mission as 2026 goes on is to educate our listeners at what you just teased, how they can level up their DI, how they can level up their direct indexing. We're going to give people examples of that all throughout the year. So if you are a business owner, you are a company executive, you are somebody that has a concentrated position, or someone who has a liquidity event that's going to be coming, this is information you can't need. David, tell a quick story. You've got 90 seconds. How have you helped some business owners that are going to be selling transition using direct indexing to limit the capital gains they're going to have on the change in control of their business when they get monetized?
Sure. Timing's the most important thing. So the more time that we have to get ahead of the liquidation event, the better opportunity we have to get that business owner in a position to help offset some of those capital gains. But I have several examples of families that we knew there was going to be a liquidity event a couple of years down the road. We modified their investment portfolio using individual stocks through direct indexing strategies in a way that we could mimic the stock index of our choosing, but generate losses that we could carry forward to offset the eventual stock sale of their company. So it sounds kind of crazy, but if we think about that, let's say that one more time. We are mimicking a stock indice on a pre-tax basis, but we are essentially banking losses in addition for this future liquidity event. So if you're a business owner out there that's trying to structure a deal 26, 27, 28, these are the opportunities that you want to be taking advantage of. These are just opportunities that not every firm is able to deploy. We can do it because we've built out such a large tech stack over the last 10 years.
833-964-PLAN. That's 833-964-PLAN. Jump out to that website, getretiredstayretired.com, getretiredstayretired.com. 2026 is about leveling up your game in all fashions. That's exactly what direct indexing can do for you and your family. If you want to learn more, you can and you should. Connect with David or myself for a complimentary strategy session. You know where to find us, getretiredstayretired.com. More to come. We want to make sure that we help you thrive in retirement because you deserve to not simply survive. You're listening to AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
You know, I said it as a teaser going out of that last bit. It's about you thriving in retirement, not just surviving. And you know where that comes from? It comes actually from winning at the margins, meaning it's doing things that aren't just directionally correct, but doing things that are best spoke, meaning they're custom tailored to you. A big part of what we do at VestGen Wealth Partners is future proofing. And a lot of this is always around your single biggest expense. Your single biggest expense is not your Cook County property tax bill. I mean, God, it's awful, but that's not your biggest expense. It's not your adult kids. It's not your mortgage balance. Your biggest expense is your income taxes. That's why we spend so much time talking about tax planning, not just investments and cash flow strategies, but this concept of leveling up, moving beyond the index-based mutual fund, moving beyond the exchange-traded fund, moving into direct indexing and direct indexing with different levels. I think it's going to be mainstream, and I want you to get there before everybody else. David, we often talk about not one, not two, but three scenarios that direct indexing helps the clients of VestGen Wealth Partners thrive. Give us a rundown of what those three are. Let's make it relatable to our listening audience on a Sunday morning.
Sure. I would say first example is everybody knows someone that might have a lot of money in one stock, and maybe it's a tech stock that did really well the last several years. And maybe that individual feels kind of handcuffed because they want to diversify out of that winning stock, but they're nervous that every time they sell, they're going to have these large capital gains. So one of the benefits of custom indexing is we create a process to methodically reduce the position size over time using this very active loss harvesting strategy or 1-30-30 strategy to create some opportunity set to wind that position down. So I think that's number one is concentrated stock. Number two probably affects the masses a little bit more, which is you have lots of securities due to the market's run up the last 3 years, where again, in your trust account or your brokerage account, you're looking to rebalance, but lots of stocks that you own have unrealized gains and you can't figure out a way to get out from underneath those. Direct indexing is another great application to help with that. And the third, I think, is what we just teased is the PE markets are hot right now. Lots of small businesses, closely held businesses have been going up for sale, having tremendous liquidity events. And as those liquidity events are happening, people are nervous that they're going to have to pay capital gains on the sale of their small business. But for forward-thinking individuals, through some of these strategies and some others that we can get into perhaps on another show, why not start building your piggy bank of direct indexing losses to eventually offset some of the tax liability from selling your company? Those are the big three. And I think that middle ground is right in the middle, where if you're trying to rebalance your trust and feel like you don't have a lot of opportunities, give us a buzz and we'll show you how we level up your non-qualified investments.
833-964-PLAN. That's 833-964-PLAN. So David, let's be specific. You talked about those three, but just in a quick 90-second story talk about how you've helped somebody just in 2025 in each of those three scenarios.
Sure. So in the first scenario, where we have a concentrated position, what we do is we agree with the family we're working with, how many gains are you comfortable realizing in a specific year? And what we're going to do at VestGen is we're going to draw those boundaries based off your family's income tax return. What's the most amount of capital gains that we're comfortable with so that we can stay in the same bracket? Then we go, right? And we start this process of active tax swaps in the account. And every time we recognize a loss, we are then able to take a profit on that appreciated security. So it happens slowly, but the more volatility we have in the market, oftentimes that gives us lots of opportunities to go ahead and reduce that position size. So I can't say with certainty how long it might take to reduce concentrated stock. But what I can tell you is you got to get the process started, and we're here to help set those tax boundaries and customize capital gains budgets. Number two, I think is business owners that are forecasting a sale. And that's where we have to use a higher level of direct indexing or 130-30 strategies or market neutral strategies. That's what I think of as direct indexing on steroids, because we have long and short positions. But what we're doing there is we set a goal of what our index is, how many losses we want to have, and we can accelerate the loss carry forward for this liquidity event. The key is, if you're selling in December, you can't be doing this, starting this strategy in November. The more time you have, the better position you're going to put yourself and your family in so that we can pay less taxes on that liquidity event. And I'll throw out this teaser that if you're a small business owner out there you're putting this on your radar, talk to a firm that actually does this. We've helped many closely held businesses with our legal teams sell for multiples higher than they ever imagined due to where the economy is today. And we also have the tax mitigation strategies to help ensure that that money not just helps you, your spouse, but also goes on for many generations. And that's where we get the most fulfillment in our business, is not just helping one generation, but setting up future generations for success and putting them in a position to define their own success. We just help back that with the economic resources. So those would be the examples. We can certainly go into more detail at a later date, I think.
But it's time to level up your game. 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, download for free our 2026 investment outlook, so you can see some of the portfolio positioning in the macro that we're using to increase the batting average for the clients that we serve. That's download for free today, our investment outlook 2026 from GetRetiredStayRetired.com. So David, there's been a lot of news about Venezuela, news about Iran, news about Greenland. But this market has remained resilient. As a practitioner and someone who works within the markets daily, and I'm going to comment too, why do you think the market has been just so, I don't know, I'm going to call it resilient in the face of what otherwise seems like large headline risk?
Well, I mean, if we go back, right, even just the last 5 years, we can make a very long list of all of these things that should have derailed stock prices. And look, the market's certainly susceptible to a normal 10 to 15% correction because, quite frankly, we might have one or two of those every year over the last 100 years. But I think if you open up the hood and look at the dynamics of the markets, and let's use technology as an example, I think what's interesting is if you overlay stock prices with profits, those lines are right on top of each other for technology. So I don't think we're at this time period, at least my personal opinion, where things are too far ahead of themselves, meaning stock should follow profits. That's what drives stock prices long term. And if you put those lines on top of each other, it doesn't necessarily seem out of bounds. And if you think about where the economy was last year, right, we put up better GDP. And with some of the tax reform that we're getting, that tax reform alone could be another 1%. We could be looking at a 4.5% GDP, maybe 5% this year. So I understand the headline risk, but the fundamentals are okay. They're not great, but they're still okay. And I think that's what's keeping investors in the game. But I'll say it's not every investor, right? We know a lot of institutions sold out last April and didn't get back in the game very quickly.
Right. And I think it's so simple. If you want to know why the market's been so incredibly resilient in the face of Venezuela, Iran, Greenland, any of these topics, it's simple. The market's resilient because the economy is still growing and people don't believe in the economic growth of the United States for some reason. The data doesn't lie. People should be paying attention to what's happening. Earnings per share can easily be up 12% this year. Now, I don't know that stock prices are actually going to follow earnings per share. But with that solid growth comes a backdrop where you want to continue to invest. You want to be investing in your future. But if you haven't been rebalancing your portfolio, then you're going to need to find ways to start rebalancing your portfolio with some safeguards based on your specific needs for retirement income and financial plans. And we're going to talk about all of that and more. But hey, listen, we got to take a break. We got to pay some bills. That's done with commercials. You know that. This is the platform of radio. When we come back, I'm going to give you some thoughts on our 2026 outlook. None of it's going to be inspirational, but it's going to be incredibly informative so that you can see how we're making proactive decisions on behalf of all of our clients. And then we're going to share with you some ways that if you get a little nervous because we're having a four-peat, yep, that's a four-peat in broad-based equity returns, David's going to share with you some cutting-edge strategies that you can use to buffer the experience. All right, 833-964-PLAN, 833-964-PLAN. That's GetRetiredStayRetired.com.
More in the know radio. You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more.
So there has
Craig.
never been a market so loved yet so hated at the same time. I think I'm reminded as to why the market now climbs a wall of worry. I mean, think of all the people that remained on Recession Island as a result of the pain points from 22 through Q1 of 2023. And I get it. It was ugly back then. Stocks, bonds, inflation running away, interest rates going up, bank failures. Remember Signature, Silicon Valley Bank, all of these names. But then people didn't see what was really here, which was the beginning of AI enthusiasm. And then people didn't recognize how that AI enthusiasm and large capital expenditure was going to move through the US economy. And then I think there's too many people that have ignored the fact that the Tax Cut and Jobs Act was renewed under what we call OBA, the One Big Beautiful Bill Act. And then David mentioned it in our last segment. All of these increases, like the non-taxation of overtime, of tip income, all of these expanded things, child tax credits, you name it, the root benefit of all of those are going to start being seen when? In the spring of 2026, when people file their 2025 tax returns. You take a look, and that is going to be coming through as a tailwind. At the same time, some of the pain points and headwinds from tariffs, et cetera, begin to subside. So pay attention to the earnings per share. Because if the U.S. market puts up $300 to $305 of earnings per share, and you see double-digit earnings growth, it'll be pretty tough for stocks not to be growing full year 2026. Now, stocks might not keep up with the full earnings per share expansion, but it is still growth, real growth, nonetheless. David, there are so many people, though, who want to stay in the game, but they want to take a little bit of Tylenol. And I think that first comes from the rebalancing discipline. That's where items like cash flow reserve accounts come from. So, David, share with us how you're helping specific families, but they have to be anonymous, generate these cash flow reserve accounts to rebalance their portfolio with purpose and intention.
Markets move very quickly these days. And, as we saw last year, right, a lot of times market sell-offs are triggered by political events, political news. They move quickly, right? So if you're not paying attention, we could be down 10, 15% in 2 to 3 weeks. So if you're on vacation and you're not paying attention, we have a problem. So I think the first thing is so basic, but you have to make your recalibrations. You got to get those recalibrations done when the sun is shining. So in upward trending markets, right? So when the markets are hitting all-time highs, that's when we might want to make changes, not to scramble when things are moving downward. So I think that starts with a really basic conversation with a lot of clients is, hey, as the market's appreciated, your portfolio naturally has a higher allocation to stocks. Now, it's basic table stakes that advisors should be doing this rebalancing automatically. But when you have outsized returns, like we've had the last couple of years, you have to be a little bit more aggressive. And we work with a lot of families that I think fall into this category of, hey, I'm super happy that we've participated in the market's upswing the last 3 years, but we have now internalized that we've made it. We have enough money and we want to hold on to it. They recognize the market's expensive. It's not overly expensive, but it's not cheap by basic PE multiples. So now what we do is we say, well, what are the different ways that we can risk reduce? And it goes back to just taking a look at perhaps taking some profits off the table from 2025. So that's part one. So Craig, you mentioned cash flow reserve accounts. We use cash flow reserve accounts as our just in case account. So what we'll do is, sit down with the family. We look at the dollar amounts that we made last year, and we might want to carve some of those profits off and put it in a bucket for a rainy day. And the design of that cash flow reserve account is not to grow substantially. It's to maintain principal, earn some interest, so that if we get into a tougher spot in the market, we have plenty of cash flow that we can use while we wait for things to get better. So I think that's step one. It's pretty straightforward, but the most important part is actually taking action.
You got to take action. As David just said, thoughts and strategies aren't worth anything if you're not actually implementing them, right? You can't just be drowning in intelligent quotient. You have to have the other form of IQ, which is implementation quotient. That's what we do, and we do it very well at VestGen Wealth Partners. So rebalance your portfolios, not just based on ingredient weights that we talk about all the time, because we want you to be cooking up great recipes, a great souffle. Well, in my case, it's a nice deep dish sausage pizza. But I want you to be cooking up a recipe that's going to get you retired and keep you retired. And that means a disciplined, systematic approach that's tested in the trenches, forcing you to take profits in publicly traded equities on the way up and relocate those profits into accounts that can be permanent and defined so you can generate the cash flow you need just in case we hit a speed bump. If you want to learn more, you absolutely can, and you should. Our phone number, 833-964-PLAN. That's 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. David, I think there's value in this, given we just saw another gigantic $2 billion M&A activity or merger and acquisition happen in the world of what I call cap and cushion. David, share with us how cap and cushion strategies could benefit clients who are looking to stay in the game, but take a little bit of Tylenol.
So part one was, refilling those cash flow reserve accounts, right? The more aggressive rebalancing. And I think that's probably the most common conversation we have in our conference room. Step two is, hey, people are still optimistic, right? So how do we maybe stay in the equity markets, but is it possible for us to transfer equity risk? And when I say transfer equity risk, what I'm saying is full market exposure using an ETF to maybe market exposure with some guardrails. And, a good way to maybe think about it, Craig, is, it's not a fair comparison, but a lot of people buy annuities because annuities say they give you the upside of the market, but none of the downside. Well, the challenge in a lot of cases is you might have to sign a contract for 7 to 10 years. But with a cap and cushion strategy, you're buying an ETF. So with an ETF, you still keep your daily liquidity. And with cap and cushion, what you're doing is you're putting a cap on the upside, so you won't participate in 100% of the upside of that index. You're going to participate up to a cap, but in return, you get to decide how much cushion you want on the downside. So how much market protection. And I think the reason that we've seen this huge deal go through recently where firm A bought firm B is investors out there are recognizing that they don't have to make a 7-year time commitment to put some downside protection in their portfolios. They can make essentially a 1 day or even a 10-minute liquidity event on their portfolio by just buying a liquid ETF to help you stay in the market, but provide a little bit more ballast to your portfolio. And if it's something that you're not familiar with, I think it's an important tool everybody should learn about and then just decide whether or not it's right for them.
That's right. So if you're willing to give away some upside in the market in exchange for some protection on the downside, you don't need to tie your money up for 5, 7, or 10 years. You can do it in a low cost, tax efficient, liquid ETF wrapper. And you might want to learn more. If you do, connect with us online at getretiredstayretired.com. That's getretiredstayretired.com. Let us show you how we can help you innovate using some cap and cushion strategies in today's marketplace. All right, there's more great information to come. You're listening to Craig and David in the Know, AM 560.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
If you haven't catch the theme as of late in the last 6 months, we might still be in a market where the diversified portfolio who's long been on sabbatical is finally back. Finally back, as you see this movement and demand for what I call real return investing solutions. You see movement and demand for people thinking, what can I be investing in that artificial intelligence isn't going to replace? And what is artificial intelligence not going to reprice? And when you start taking the cornerstones, the hallmarks of a globally diversified multi-asset class portfolio, paired together with true retirement planning, it is a game changer. That's the hallmark of the things we do at VestGen Wealth Partners, and we like to think that we do them very well. David, piggyback on a part of that and bring us into a deeper dive on one of those teasers I just laid out.
Well, you had asked, what do these conversations look like when we're sitting down with families that are on that cusp of retirement or maybe recently retired, and we talk about how we rebuild and recalibrate portfolios. Part one was, building those cash flow reserve portfolios when the sun is shining. So taking some profits off the table and having a more aggressive rebalance for some families. Part two was what I call transferring equity risk. For those that want to stay in the game, they want to stay in equities, but they want a little bit more downside protection. We can look at implementing some liquid cap and cushion strategies so that if you change your mind, you can easily redeploy that capital a week or two down the road. I think part three is just recognizing that we're in a different world. We went through a time period where for 15 years, the US was the only place to invest. We had the best performance. Foreign markets still generated positive returns, but they were lagging behind. So I think for part three, I would say, number one, and this started in 2025, we need to take a look at geography. Number two, we have to recognize we have a weaker dollar. So we might want some alternatives to the US dollar, crypto, gold, silver, commodities. And part three is we might want to own some non-traditional investments, what I call hard assets, even things like real estate. And if you think about that, right, markets move in trends. And if we use real estate as our example, real estate wasn't a great investment in 23 and 24. We had interest rates moving dramatically higher, but think of where we are today. Now we're talking about interest rates moving down. Real estate experienced almost a 20% decline, peak to trough, and we're 7% off the bottom in non-public traded real estate. The entry point looks a lot better today, and the backdrop looks better. And when you have a White House that's looking to get housing going again, the opportunity set looks good. So I think the takeaway is it's not option 1, 2, or 3. For most families, we're looking at a combination of implementing all of these strategies. But the way we do that is we base that off their financial plan.
And that is the key. That is the key. You deserve to worry less, which allows you to live more. And when you worry less and you live more, you're blessed with the chance, the opportunity to pursue happiness. That's all the things you've ever worked for. And understand, when you were working, you were trading your most valuable currency, time, for money, so you too could have a future. You got to handle your health, but you also got to handle your wealth. And that's exactly what the financial planning process is about. And I think you got to move past these online calculators. You got to move past these things that are back tested. I do that in air quotes on radio. You got to move and work with a firm that knows what it takes to get retired and stay retired by building solutions that are durable and can take a stomach punch, because you're working with advisors who have been through hell and back. When I say hell and back, I mean, come on. The dot-com bubble, the great financial crisis, the flash crash, all the concerns and considerations that came from COVID. I mean, you need to work with people that are tested in the trenches so that you can see that the strategies they were using for clients, if clients were able to survive back then, these little challenges we're experiencing now, they're kind of like speed bumps on your journey towards financial freedom. And I want to give you an opportunity to connect with us. It's a new year. Let it be a new you. If you're ready to level up your game because you want a holistic experience, one that brings a multifamily office experience where you can have the investments, the cash flow modeling, the financial planning, goals-based and cash flow-based. You want to work on solving for all of the protections. Asset protection's a very big deal in America. You deserve asset protection too. You want the income taxes. You want the estate planning. You want the retiree healthcare. Being able to get all of that under one roof from a group of professionals that comes together in the conference room, that's the VestGen Wealth Partners difference. And I want to make sure you get that for you and your loved ones. 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. When you're there, download our 2026 market outlook for free. That's getretiredstayretired.com. So David, you talk that it's not one, it's not two, it's not three, it's all of those things. It's investing and creating a foundation for real return this year. It's about investing in other forms of hard assets, because we do need to be paying attention to what AI can't replace and what AI can't reprice. It's likely act two, or the follow-on act of a geographical lesson, where courtesy of items like de-dollarization, people need to be shifting monies to the other side of the ponds. What goes beyond those thematics that are getting incorporated as satellites into portfolios of clients at VestGen Wealth Partners?
Picks and shovels. So take all of the investment themes that have really driven your portfolio over the last 5 years. And we know what it is. It's capital expenditure on artificial intelligence. And that's likely to keep going. And one of the reasons I believe it's going to keep going is a lot of these big companies that are spending money, while it's a substantial amount of money, they're taking the money out of their cash reserves. Now, you've had a handful of Mag 7 companies issue bonds, but a lot of them are just paying for this stuff with cash. That's good. We don't want them to be borrowing money. So I think this keeps going. But what we need to think about is if those are the stocks that have had massive outperformance, what are the other parts of the market that we can invest in that help these companies achieve these goals? We need power. We need fiber optics. We need the data centers. And I think that if we're rebalancing, we might want to rebalance into some things that might not be trading as at the same multiples. So maybe they're a little bit cheaper. And those are things that we look at. I think the key is none of this is a one size fits all. So how do we do it? First thing we do is we figure out what your cash flow plan looks like. The second thing we're going to do is we're going to stress test your cash flow plan with more conservative outlooks. We're not going to tell you that over the next 5 years that the market's going to have the exact same returns, because nothing is linear with stock investing. So we're going to have plan A, B, and C. And after we create plan A, B, and C, then we're going to reverse engineer the investments. And you, as the client, are going to have the opportunity to pick and choose how you want to implement, because you need to invest with your values and you need to be investing based off what your 1040, your tax return looks like.
So connect with us today. GetRetiredStayRetired.com. GetRetiredStayRetired.com. Make 2026 the year that you level up your game, so you too can not just survive, but you can start thriving in retirement. And all of that comes from a well-engineered plan with multiple disciplines and multiple professionals all coming under one roof. Take advantage of that complimentary strategy session today. Download from our website our 2026 outlook at GetRetiredStayRetired.com. More sincere and actionable ideas for you in a moment. You're listening to Craig and David in the Know with VestGen Wealth Partners on AM 560, The Answer.
with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
For everybody listening, you go through life. Life is a journey, and life is never a straight line. Life evolves around a curve. It really does evolve around a curve. And while we can't put words to it, for so many of us, there becomes this point in time, and we've started to refer to them in the office as inflection points. And David, when people hit this inflection point that we call it, what is that typically referring to? Why are they coming to us? And what is it that we're curing and solving for?
The inflection point to me could be a change in employer. It could be you just paid off your kid's college and it's finally just you and your spouse, and you have time to reflect on what's important about money to you and what that next chapter is going to look like. Or it could be we're a year or two out from retirement or recently retired, and we need to do a reset and a recalibration of what our plans look like. That's when people find us. People don't find us because they have financial problems or fires to put out. People find us because they want a single hub to go to where they can strategize on all things financial, not just investments, and they can receive unbiased, non-cookie cutter advice of people that have gone through multiple bear markets in multiple bull markets, and that offer services that not all firms can actually deliver on. That's the inflection point, and that's what gets people in the door.
No, and I think what keeps them in the door is the proactive level of communication, the strategy, and the commitment by everybody. It should be everywhere, but it's not. But the commitment here is that the client's interest always comes first. Your interest, your improvement, your betterment, your ability to not just get retired and stay retired, your desire not just to survive, but thrive in retirement. That's what gets everybody up out of bed every day with passion and vigor to come and be in a world of professional service to you, bringing the cutting edge proactive strategies that you need in an ever-changing landscape, an ever-changing global economy, and markets that are still just markets, but they're markets that move faster than they've ever moved in the history prior. You too should want to level up. 833-964-PLAN. That's 833-964-PLAN. Get out to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. You've been listening to Craig and David Bolanos in the Know with VestGen Wealth Partners on AM 560, The Answer.